When it comes to being successful in life, business or not, there's something to be said for listening to the masters. It may seem as though the veteran members of the investing community are stuck in their old ways, but the fact of the matter is that these old ways got them to the top of the food chain. In this day and age, how are you supposed to get started on creating your own pile of wealth? Financial security doesn't come easy, but the path may be simpler than you expect. Today, we're turning to one of the biggest masters of the financial game, Warren Buffett. Buffett has given out advice left and right, but it can be hard to track it all down. Because of this, we've collected his 7 simple rules for investing smart so that you don't have to. Knowledge truly is power. So grab a notepad and make sure you really understand these tools for success. Welcome back to Profit Protection. On our channel, we bring you news about ideas and information from the thought leaders in the financial world. We break down headlines about financial markets, cryptocurrency, and digital assets from the people who understand them the best. If you found this channel educating and entertaining, we would appreciate it if you liked and subscribed. This is the easiest way to support us so that we can continue bringing you high-quality content. Alright, let's dive in. Warren Buffett is the king of intelligent investing. From a young age, he was involved in small business ventures like selling products door to door and running a small pinball machine empire. In his later years, he earned a Master of Science in Economics from Columbia. After graduating, Buffett attended the New York Institute of Finance. By the time 1970 rolled around, Warren had made many lucrative partnerships with investors. He was investing other people's money and pulling in massive returns. This led him to purchasing Berkshire Hathaway, turning the textile business into a financial leviathan. Buffett and Berkshire Hathaway have grown in wealth many times over since they began buying up stock in companies. Corporations like Coca-Cola, Goldman Sachs, General Electric, IBM, and more have been generating huge returns for him and his firm. So, what was the secret to Warren Buffett's success? You can't be lucky that many times in a row. There has to be something else at work here. Luckily for us, he enjoys sharing his strategies and principles that have helped him to get to where he is today. We've collected 7 very simple rules that Warren Buffett has followed to create his wealth. If you base your investments off of solid fundamentals, you will downsize your risk and profit more consistently. Let's take a look at 7 simple Warren Buffett rules you can use to create wealth. Number 1, managers must have integrity and talent. When Warren Buffett said this, he was talking about the people he hired to work at Berkshire Hathaway. These new employees would manage both accounts and teams of analysts. According to him, integrity was important because it meant that you could trust them to make the correct decision. When combined with talent, integrity can create an incredibly valuable manager. Well, you probably aren't a hedge fund manager or financial giant yourself, so what does this matter to you? It actually matters a whole lot. You yourself are the manager of your own investment account. Your integrity and talent make all the difference when it comes to making more money. In this case, how can you build your own integrity and talent? For one, educating yourself using videos like these can certainly build your skill. Most talented people you see in the field of finance are actually just knowledgeable and experienced. Take the time to build your own skill set. It will pay off. Pun only slightly intended. When it comes to your integrity, take a look at your own decisions. Did you sell out of fear when you swore that you would hold the stock? Did you invest more money than you should have because you got excited? Your integrity matters because you have decided to trust yourself with your money. Stick to your strategy and invest with integrity. Number 2, invest by facts, not emotions. The real world doesn't care about your feelings. Plain and simple. No matter how much you love the stock, it can still crash tomorrow. Despite your dedication to Ethereum, there's no telling where the price will go. Naive investors get burned when their emotions guide their decisions, only to be shut down by the facts. So if we're going to invest based on the facts, what facts should we pay attention to? It will take some learning, but anyone can come to understand the true valuation of a company. Earnings report, historical charts, market research, and much more will help you. Investing is a thinking man's game, so take the time to dig into the fundamentals. One way to help yourself base decisions off of facts instead of emotions is changing the media that you consume online. All of our feeds are full of finance talk. Are the accounts on your screen spreading fear and excitement about the new hottest stock? Or are they providing you detailed information about the value of a company? Be clinical about your investments. Only buy into companies which prove to have good fundamentals and business plans. Be wary of anyone trying to hype you up or scare you away from a stock. Number 3, take advantage of dividend-paying stocks. One of Warren Buffett's lesser-known tips is to invest larger amounts in stocks that pay dividends. Companies who are routinely hitting their expected earnings and more may opt to reward their shareholders with dividends once or a few times per year. Most companies do not and invest the money back into themselves instead. Berkshire Hathaway, Warren Buffett's holding firm, makes hundreds of millions in dividends each year from its Coca-Cola investments. As you can see, the difference can be sizable if your holdings are large enough. Like any stock, just because you can't buy thousands of dollars worth doesn't mean it isn't a good idea financially. As you examine which companies to invest in for the long term, take a look at the dividend payouts of companies. It doesn't need to be a requirement for you to buy, but the extra cash you receive back is a nice cherry on top. Number 4, buy wonderful businesses, not cigar butts. It's often the case for gurus online to be hyping up a stock that is, for lack of better words, complete trash. There are plenty of voices online that want you to buy subpar companies off of rumors or chart patterns. When you buy a stock or a digital asset, you want to be able to hold it for years. Warren said it best.
I've been taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap. And that I was taught that, we'll say in 1949 or 50. It made a big impression on me. So I went around looking for what I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts and you find this on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. Disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake. Although you can make money doing it, but you can't make it with big money. It's so much easier just to buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price.
Number 5, only buy stocks that you understand. You're investing in companies based on how you expect them to grow in the future. While there are certain parts of the balance sheet that play into this, there are many more real-world factors. The regular investor would miss a lot of important things pertaining to the industry or products the company is involved with. It's a lot like starting a business. You can have funding and loads of hype, but if the product fails or a competitor takes your idea and improves on it, you're done. Knowledge of the industry will downsize your risk significantly. Number 6, when you see a great opportunity, take it. There's something to be said for being conservative with your stock picks or crypto funds. Being too open to opportunities can backfire over time, as they do not all turn out how you imagined. Despite this, the richest investors made their millions by trusting their gut when they saw a great opportunity. When it comes to your own area of expertise, as we talked about in the previous rule, you may notice opportunities that aren't recognized by the average investor. If you feel as though you have a good handle on a market-moving event or the growth of a certain company, take advantage. Don't beat yourself up by dwelling on your missed opportunities, though. Nobody can hit every good opportunity, even the greatest among us. Let Warren Buffett tell you for himself.
The biggest mistakes we've made by far, biggest mistakes I've made by far are mistakes of omission and not commission. I mean, it's the things I knew enough to do, they were within my circle of competence, and I was sucking my thumb. And that is really, those are the ones that hurt. They don't show up anyplace. I probably cost Berkshire at least $5 billion, for example, by sucking my thumb 20 years ago or close to it when Fannie Mae was having some troubles, and we could have bought the whole company for practically nothing. And I don't worry about that if it's Microsoft because I don't know it. Because Microsoft isn't in my circle of competence. And so I don't have any reason to think I'm entitled to make money out of Microsoft or out of cocoa beans or whatever. But I did know enough to understand Fannie Mae, and I blew it. And that never shows up under conventional accounting. But I know the cost of it. I passed it up. And those are the big, big mistakes. And I've had plenty of them. Unless I tell you about them in the annual report, and I resist the temptation sometimes, unless I tell you about them in the annual report, you're not going to know it because it doesn't show up under conventional accounting. But omission is way bigger than commission. There's big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come, because you're not going to get 500 great opportunities.
Don't sell unless the business fundamentally changes. It can be tempting, as an investor, to drop a company that seems to be underperforming compared to your expectations. Warren Buffett will tell you that this is one of the worst mistakes you can do. When you have a solid reason for buying a company's stock, nothing should change your mind unless the company itself changes. When a business undergoes fundamental changes like dropping a product line, changing up management, or making acquisition, you need to attempt your due diligence as a shareholder. Is this going to throw a wrench in your plans? How does this change affect your original strategy? This is as much of an emotional decision as it is logical. You may feel afraid or excited to hold onto a stock as the business makes headlines, but in the end, you need to base your decision on reason. So there you have it, folks. 7 solid strategies for improving your financial standing. Did this enlighten you? You can show your support by liking this video and subscribing to our channel. It helps us to continue producing high-quality content for you guys. We believe that learning from the best in the industry, like Mr. Buffett, is a major key to finding financial freedom. When you approach your own personal investment journey, remember that it isn't a race. Your neighbor may have bought a house a year before prices went sky high, or your friend may have bought Bitcoin before it took off. Heck, Warren Buffett made $100,000 before he graduated college. The point is, you can compare yourself to others' gains all day long, but it won't help you become rich. Purposefully earning and taking action are what translates into real-world results. If you're on this channel watching this video, you're well on your way. Everyone, we really appreciate you tuning back into Profit Protection. Remember, this channel isn't financial advice. Rather, we want to bring you the most important ideas from the smartest people in the room. The crypto, digital asset, and financial market spaces are full of bright minds that can educate us. Profit Protection want to keep it informative and entertaining. If you enjoyed this video, please like and subscribe. It helps us to continue producing high quality content for you guys. Thanks for watching. See you next time.